So we're out here for the Aspen Economic Strategy Group meetings. A lot of talk about fiscal issues, monetary issues, but we all have now the key jobs figures. A little bit lighter than expected, 187,000 instead of 200,000. A little heavier than expected on the wages. What did you take on?
The job market is cooling a little to kind of a balanced level, but it's still extremely strong. That's the strongest part of the economy by far, is how low the unemployment rate is, and people can get a job if they want a job.
But what about the wages? We're now, these numbers were 4.4% year over year, I believe it was. That doesn't sound like something consistent with getting to 2% inflation overall.
The way I view it is two things. One, you can't say anything about wages until you actually know what's happening with productivity. We got some productivity numbers. They were strong for the quarter. That's very noisy, but if you have strong productivity growth, you can have wage growth and it doesn't generate inflation. And the other thing about wages is they're not a leading indicator of price inflation. They're backward looking. Wages move more slowly. When things happen, we get shocks, the prices move first and then the wages. So when we see what's happening to wages today, this is kind of an amalgam of a bunch of stuff that already occurred. I think if you want to know if you're beating inflation, go watch the inflation. You know, the price series, and especially the new months of inflation in the core. That's really what you want to be watching.
What are those numbers telling you right now, particularly goods inflation? Is it a bit stickier than you thought?
It has been, but the last couple of readings have been pretty positive. It's important that you raise this goods. Loosely, if you look at core inflation, you got goods, you got housing, you got services, not including housing. And we've much remarked on the stickiness and persistence of services inflation. But we knew that's not where we went wrong over at the end of last year, beginning of this year, with inflation lasting a little longer than we thought. It has been that goods prices, while down, have not gone all the way down to where they were before the pandemic. I feel like that's kind of started, and that's put the Fed on this line. I mean, it's a thin line to walk, but getting the prices down without having a big recession, we're going to Johnny Cash this thing and walk that line, and that's for sure the goal.
So, Austin, we talk about things like the jobs numbers as if there's one national number, when in fact we know there's no one national number. Indeed. There's a lot of individual numbers all around the economy. You have a region that absorbs a fair amount of the economy. Give us a sense of the variation across your region.
Yeah, so the region of the Chicago Fed is almost, but not quite exactly, Iowa, Wisconsin, Illinois, Indiana, Michigan. So it's kind of heart of the Midwest. It's got a lot of industrial. It's the most manufacturing intensive of all the Fed districts. There's a lot of food, there's professional services, transportation and logistics. That's a lot of the distinctive concentration. But as you point out, there's a wide variability within that region. So I went to Des Moines, and in Iowa, the unemployment rate is down in the low 2%. And when you talk to people there about, hey, what do you think? Some people think it might be a recession. They, what? we can't find anyone. Where if you go to regions where they're more right on the edge of the business cycle, the unemployment rate in some urban areas can be well elevated compared to rural areas or in industries where things are booming. The thing I would say that's been unusual about this business cycle has really manifested in the district, which is normally manufacturing is the most cyclical part of the economy. And so it's really at the bleeding edge of the business cycle, and everybody wants to go out to Flint, Michigan, and various places that are industrial to get a sense of where we are in the business cycle. But this downturn from COVID was centered in services, and manufacturing actually went up people bought more cars and TVs and stuff like that. The RVs in Elkhart, I went out, but the very first speech I gave was out in Elkhart. We toured the RV plant, and the demand for RVs was through the roof. You can't believe how much, how intense the job market competition was there. So as we come into this recovery, it doesn't look like it normally does, even within the district.